Well, hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be talking about liabilities and payroll. the fun stuff, right? Payroll. We'll be looking at payroll from the business side of things, and we'll also be looking at current liabilities like wages payable, accounts payable, anything payable, taxes payable. So we'll talk about current liabilities, which is anything that the business owes to someone else within 12 months or less. That makes it a current liability. And we'll talk about payroll, which is the fun way that businesses pay their employees. And we'll talk about all the deductions and how all that works and how payroll taxes work. And it'll be a good conversation. I think that you'll all get some entertaining information out of the payroll conversation. So before we jump into our discussion today on current liabilities and payroll, I do want to quickly talk about the mid-semester survey, which for me was enlightening. Overall, most of you are throughout the course have been doing pretty relatively well. I want to talk about grades for Principles of Accounting 1. This course is very difficult. I said that in the very beginning, yeah? And you know it is. You know this course is hard. The vast majority, and I'm just talking about statistics, yeah? Vast majority of students in Principles of Accounting 1, they average about a C grade, a B grade, usually around C or B. That is very, I'm going to use the word normal, okay? I know the word normal. You all don't, you know, normal has changed, but it's still normal. So grading distributions. Typically, students who take Principles of Accounting 1, they earn a C or a B. That's been on average the norm for the past since 2008 here at UDC. That's very standard. Students typically do better in Principles of Accounting 2, usually averaging A or B. That's been my experience from it. Why is that, you might ask? Even on an 8-week format, students typically perform better in Principles of Accounting 2 because there's less content to digest in an 8-week time frame. On average, it's one chapter a week. Sometimes there'll be two. So I think, if you're averaging like a B grade or a C grade right now, or even a D grade, I don't want you to panic, okay? Because I promise it gets better. Uh, a lot of it has to do with the fact that this course is it's quick. It's a quick course. I mean, we're covering 2 chapters a week. It's 8 weeks. It's like you're covering the same amount of content as you would if it were a 16-week course. And so, because of that, that's what adds to that pressure, if you will. So if your grade isn't where you want it to be, it's okay, because uh, passing is a C or higher, and uh, Principles 2 is a lot less condensed than Principles 1 is, even in an 8-week format. So for those of you who are coming along with me in March to Principles 2, you'll see that, right? It's a lot less condensed, and so I think that on average, this course is doing pretty well in comparison to the same time last year, if you will, when I taught this course in the 8-week format. In addition to that, I want to call out a couple of things. If you ever need tutoring, if you ever need that extra help, even if you don't want to talk to me, because you can always talk to me, you know that, right? So office hours, you could do, uh, we could set up additional hours outside of my office hours if we need to. We could do, email, we could do telephone, whatever. That's cool. You have to be the one to initiate that, because sometimes I don't know what you're having trouble with. right? So you need to tell them. Uh, and I'm here for you. In addition to that, Professor Remy with the tutoring, uh, it's good. It's good. It's decent tutoring. It's not like something you'll get with like tutor.com or whatever other resource. But Professor Remy's pretty good. He's been doing tutoring with us for a long time. So um, I do recommend reaching out to him because I think it's good service.
Professor,
Yes, ma'am.
did I not hear you correctly? You said you are doing accounting too next spring?
Uh, in March, in this March, next month, Principles 2 starts March 15th, I think, right after spring break is done.
Oh, you do another course right after this course?
Yes, ma'am.
Is it just like the same amount of time?
Same, yep, 8 weeks.
8 weeks? It is accounting too?
Yes, ma'am.
Oh, okay. Thank you.
Yeah, you're very welcome. Yeah. So again, if you're ever running into trouble, please, I want you to let me know, and I'll help you. I don't ever want to have any of my students fail because, first of all, I feel terrible when somebody fails. Second of all, I don't want you to feel like you failed yourself because you didn't reach out for help. So if you need help, you let me know, and we'll get you the help.
Oh, yes, Professor.
Mike,
When you say the next class, if I can ask, do you think there's a possibility for any accounting two to possibly be during the summer? Any, whether it be you or another teacher?
it's hard to tell. The university hasn't planned that far ahead yet. Um,
No worries.
Typical
Yeah, it
UDC
makes
thing,
sense.
right? Uh, yeah, UDC is not the quickest when it comes to planning, so
I know that.
I know that too.
Like,
uh,
I'm just asking, just so, because
there's a
I'm really
slim
hoping.
chance. There's that slim chance that 1 and 2 may or may not be offered. Um, it also
Okay.
depends on how many people sign up for it, because the
Well,
university needs like 10 students or more for a class to run.
I'm going to be the first guy signing up if that's the case.
Okay, so
It's more so if you more so if you're in it. More so if you're in it.
yeah, yeah, which I normally am, but and again that's up to the university to get it on the schedule. So they usually do offer one or the other in the summer, but I can't tell you, and that's even quicker. That's 6 weeks each. But otherwise, I'm pretty confident they'll both run in 8 week formats again in the fall. I can tell you that much. That I'm pretty confident of. Good question. Okay, any other questions, comments, concerns before we jump into it? I'm sorry, the mid-semester feedback. So the reason why I'm bringing up all this stuff to you is because of your feedback. So everyone who submitted it, I read it. I adjusted your midterm grades based off of the questions that you answered. Some of you didn't answer all 5 questions. You wrote NA, so you didn't get a point for that one. Because NA, means you're not answering it, which is fine. Um, But I adjusted the midterm grades based off of the midterm semester feedback survey because it's extra credit points, right? So if you see, oh, my grade went up, it's like, well, that's what you took the survey. Um, with your feedback, a lot of the feedback was surrounding the positive feedback. Sure, yeah, was the format of the course, the teaching style, things like that. Thank you. Um, some of the more critical feedback was uh, we cover too much stuff in a short amount of time. Which, believe me, I hear you. I do. I honestly, I hear what you're saying, and I want to reiterate the fact that it's an 8 week course, and we're covering the same amount of content that we would normally if it was a 16 week course. So I understand it's moving very quickly because it is, and we're covering the same amount of work in condensed format. So, but again, if you need help and you want that extra attention, office hours, tutoring, email calls, all that jazz. Please, please, please. So outside of that, I think overall we're doing well, and we're almost there. I mean, we're in week 6, so we're moving very strongly. So again, thank you everyone so much for that. And any other questions before we start the discussion on payroll?
Professor, I have a question about the extra bonus questions.
Yes, ma'am.
So on my grade book, it appears as 5/0.
Yep.
What does that mean?
Yeah. So the way that Blackboard works is it doesn't the system Blackboard doesn't allow for me, the professor, to set up extra credit in the grade book. So what I had to do is I weighted it out of 0. You earned 5 points for the 5 questions you answered out of 0. Then what I did is I adjusted your midterm score, and if I had to use some other scores, upward by the 5 points in order to get the balance out. It's just the way that the system is designed. I believe me, I told Blackboard about this issue because it makes it confusing for you and for me, because there's not an option for extra credit in Blackboard the way it's designed. So that's why it looks that way. I'm sorry that I know it's confusing.
No worries, Professor. Thank you.
Thank you. Yeah, good question. Okay, let's go ahead and get started. I apologize it took up 10 minutes talking about that stuff, but I thought it was important. Okay, let's talk about liabilities and payroll. So as I had mentioned before, and as you already know from going through the first few chapters, the concept of the word current means within 12 months. Current means within 12 months or less. That's what makes it current. So anytime you hear the word current, think 12 months or less. And then we have this word called liabilities. Liabilities is anything the company owes to someone else. So examples of this would be, I owe money to my employees for the work that they perform. That's called wages payable. I owe for the electric bill I received last month. That's called accounts payable. I owe the taxes I collected from my sales last month. That's called taxes payable. So liabilities is anything the company owes to someone else. Current liabilities means I owe it within 12 months or less. And we'll talk about payroll. Payroll, of course, is the fun part. That's when you get paid, and we'll talk about what it looks like from the company's perspective as well. And of course, don't worry, there will be 1 or 2 ratios. All right, let's talk about the liabilities. Liabilities, current, 12 months or less. Liabilities, long-term, greater than 12 months. That's current liabilities. I am going to pay it within 12 months. Long-term liabilities, I'm going to pay it greater than 12 months, longer than 12 months. Long-term liabilities are typically things like loans, student loans, car loans, mortgages. Uh, they're loans that are long-lived, right? We have to pay them consecutively for many months. That's a long-term notes payable or a long-term liability. So current, paying it within 12 months or less. Long-term, anything after 12 months is considered long-term. You guys already know it. It's not nothing new. So it's exactly as it sounds. When it's current, less than 12 months. Long-term, greater than 12 months. And I want to talk about this other concept real quick called the current portion of long-term payable. Current portion of long-term debt. Okay. That sounds funny, right? Current portion of long-term debt. I want you to think of a car loan. Okay. Let's say you own a car, but you're making payments on it. Obviously, is a liability. I think they were paying something for debt reasons. That's a liability. So I want you to think of car loan. Let's say you bought a car. Okay, and you bought a car for $25,000, and let's say the the terms of the car loan is for 5 years. So you're going to have it all paid off in 5 years. Great. So the current portion of that car loan is the first 12 months. And then it keeps moving, right? For like 12 months, then you pay a month off, then it's still 12, it moves to the next 12 months, and then it moves to the next 12 months, so forth and so on. It's always 12 months. We call it the current portion of a long-term debt. Does that make sense? Just want to make sure everyone understands that term, current portion of a long-term debt. Good, yeah? Okay.
Understanding him, sir.
You got it, Mike? Great. Okay. Sometimes there's some uncertainty in liabilities. Sometimes the information is confusing. You get a bill in the mail, and the bill says, oh, check payable to this company. It came from a different company. Who do I pay it to? Right? Yeah, sometimes it's confusing. So it's sort of like, okay, so uncertainty, who do I pay? Sometimes it's also uncertain when to pay it. Sometimes you might get a bill in the mail. It'll say due upon receipt. Well, when the hell is that? Right? Due upon receipt. That's unclear. It's like due upon receipt. When I receive it? When you receive it? When who receives it? Due upon receipt. I don't know what that means. It's unclear to me. So sometimes it could be unclear of when to pay the bill. Right? Because other times it'll just say, hey, it's due this day. Right? Sometimes it's clearly spelled out, like the electric bill you get. It says, oh, it's from Pepco. Okay, so I know, I got to pay the Pepco. It'll say, oh, it's due February 17th. Okay, I know when to pay it. It says when it's due. And then the third uncertainty sometimes we get in the bill is how much to pay. Well, yeah, once in a while, it depends. But sometimes you'll get a bill, it'll say who you pay it to, when it's due by, but it'll say estimated payment amount. Who's estimated? What do you mean estimated? So how much do I owe, right? So sometimes liabilities can be uncertain when it comes to who to pay it to, when to pay it, how much to pay, because the terms are not clearly spelled out on the bill. That happens from time to time. Hopefully you'll never run into that situation, but it does happen. One says due on receipt. Receipt by who? Or estimated payment. What do you mean estimated? It's like, it don't mean estimate, give me an actual number. So sometimes that happens in billing. And so the ways to avoid stuff like this is if you sign an agreement with someone, to establish a line of credit or you're buying an asset like a car or you're buying a house, and anytime there's that type of relationship between the buyer, you, and the seller, someone else, make sure that it's clearly defined. Who do you pay, when do you pay, and how much do you pay? You know, because again, sometimes some of these individuals that we deal with, they're not as clear as they should, probably should be. Known liabilities. Companies should always know, really should always know, who you're paying, what you're paying, how much you're paying. Call these known liabilities. Known liabilities are liabilities that a company typically always has. All right. Accounts payable. Accounts payable is the accumulation of the accrual of payables. Accrual of payables. Accounts payable. Accrual of payable simply means that we have a bunch of bills from a bunch of different vendors that we have to pay within 30 days, 60 days, 90 days, whatever it is. That's an accounts payable. You got your electric bill, you still haven't paid it, that's accounts payable. You got your telephone bill, you haven't paid it yet, that's accounts payable. Your other utilities, those are typical accounts payable. There are, the list goes on and on. Accounts payable is simply, you got the bill, you just haven't paid it yet, and it's from one of your vendors. That's accounts payable. That's a known liability. I know I have that bill, I entered into accounts payable, I haven't paid it yet. It's a known liability. Then we have sales taxes payable. Sales taxes payable gets generated when you sell something and you collected sales tax. So think of like that time yesterday when you went down to the deli or the convenience store and you bought something, right? You bought something, you probably had to pay sales tax, right? It's like, oh, it cost me $1, I paid them $1.08. Well, we know that the 8 cents is sales tax, 8% sales tax. So what happens with that 8 cents, right? Sometimes people think of this. What happens with the 8 cents? I bought it for $1. I gave them $1.08 because that was the total. That 8 cents is sales tax. So what happens with that is that vendor, whoever sold you whatever it is that you bought, they took that 8 cents, they held on to it, and then at the end of the month or the end of the quarter, they send that sales tax, that 8 cents, off to the Treasury, the Department for DC. Okay, the tax agency, yeah? That's called sales tax payable. When I collect the 8 cents, the $1.08, I don't ring it up as $1.08 revenue. The 8 cents wasn't revenue. The dollar was. The 8 cents goes to sales taxes. So that's generates what we call sales taxes payable. And then of course I'll pay it off to the tax agencies. Unearned revenue. Oh, we know that one's a liability. We talked about that one a couple times. Remember my lawn care business I was telling you about? Unearned revenue. That's when, because Mike and I, we got into the lawn care business, and so what we did is we went around to the neighborhood, say, hey, I'll mow your lawn for the whole season. They'll pay us up front. It's called unearned revenue because I didn't mow the lawn yet, but they paid me in advance. Okay, that's unearned revenue. Unearned revenue is when you haven't earned it yet. That's a liability. It becomes earned revenue after you mow the lawn, after you provide the good of the service. Unearned revenue is liability. The reason why it's a liability is because you might have to give that money back. You know, if they decide, hey, I don't want you mowing my lawn, or you know, it's a liability because it's unearned. Short-term notes payable. Short-term notes payable. We talked a little bit about this last week, if I'm not mistaken. Remember when we talked about accounts receivable? We went into like great detail about accounts receivable, about how sometimes, somebody might not pay us, and then we have to go through this process to collect it from them, and then sometimes we might convert their their account receivable into a note receivable. Yeah, it works the same way on the payable side of things. So what happens is, let's say the business, forgot to pay somebody, one of my vendors, so they'll call me and say, hey, we'll convert your account payable into a note payable, right? Short-term note payable means I have to pay it within 12 months or less. It's usually like 90 days on average. Payroll liabilities. Oh, this is a good one because we're going to talk a little bit more about this in the next 45 minutes. Payroll liabilities. Payroll liabilities is, it's multifaceted, okay? There's a couple of things going on here. Payroll liabilities, that is simply my employee worked for me for 2 weeks. I have not yet paid them. That's a payroll liability. I owe them the money. I'm going to pay it next Friday, right? So the employee worked for me for 2 weeks, haven't yet paid them. That's called payroll liability. The reason why I said it's multifaceted is because it's not just the wages we gotta pay. Okay, yeah, I gotta pay my employee their hourly earnings based off the hours they worked, times the amount that they earn, their wages, but which we call that gross pay. But I also have to pay the taxes, the payroll taxes. I gotta pay any other remittance, and we'll talk a lot about those. But that's all a part of payroll liabilities, and we'll talk about that. We also have what we call multi-period known liabilities. This is us knowing about our long-term liabilities. So here's an example. This goes back to the payroll thing. Here's an example of the sales tax. So August 31, Home Depot. Oh, nice company. I like that one. Home Depot sold materials for $6,000, subject to a 5% sales tax. That's obviously not DC, probably not ER. 5%. Okay, that's nice. So Home Depot, we sold $6,000 worth of stuff, but we collected $6,300. The $300 we collected cash, we collected $6,300 in cash, right? $300 of that $6,300 is taxes. It's sales tax. So, and how do we know? How do we know that's correct? If I sold $6,000 worth of stuff and I have to pay 5% sales tax, 6,000 times 5%, 300. So the journal entry I make for the sale is I debit cash 6,300. So that's how much cash I'm taking into the company from the sale. I credit sales 6,000. Remember, I only sold $6,000 worth of stuff. The 300 is sales tax. So I credit a liability account called sales taxes payable. So what this transaction does is it increases my assets, 6,300, my cash. It increases my sales, which is, of course, an equity account, 6,000. And I'm increasing my sales taxes payable, which is a liability account, 300. So the accounting equation is 6,300 equals 6,000 plus 300. Assets equals liabilities plus equity. 300 plus 6,000. But you see how that works. Here's an example, unearned revenue. Remember, unearned revenue is when we collect cash from our customer before we have performed the good of the service. So here's an example. I am the Washington Capitals, and our venue is putting on a concert. So we're going to sell tickets. So here's an example of a ticket sale that we make. On June 30th, we sold, man, how expensive is this concert? We sold 8 concert tickets for $5 million. Did we really? That sounds a little high. No. We sold concert tickets. Okay. On June 30th, we brought in $5 million in cash. So we debit $5 million in cash and we credit unearned ticket revenue. That's a liability account. On October 31, on October 31, I had recorded the concert. The concert was performed. So I debit unearned ticket revenue and credit ticket revenue. Convert it from unearned to earned. Oh, for 8 concerts. Oh, not 8 tickets. I'm sorry. I thought that was a little high. Okay, so $5 million for 8 concerts. We all know Selena would have made more than that. Okay, so come on, Selena made way more than $5 million for 8 concerts. That's ridiculous. Okay, anyway, so Selena put on 8 concerts. She collected the cash in advance of those eight concerts. Debit cash, credit on her ticket revenue. On October 31, she performed 1 concert. So we debit unearned ticket revenue 625,000, credit ticket revenue 625,000. How 625? $5 million times 1/8, which is 1 out of 8 concerts. Okay. What about short-term notes payable? So remember, short-term notes payable is a note or a loan that I have to pay within 1 year or less. A couple reasons for it. Overdue accounts payable. I forgot to pay someone. So they called me and said, hey, you forgot to pay me. And I'm like, oh, I'm so sorry. They're like, yeah, well, we're going to have to charge you interest. We're going to convert your account payable into a note payable. Okay. Or you might need a short-term loan from a bank. Let's say you own a shop and you're putting on a small addition. That could be a reason for a short-term note payable from a bank. There could be other reasons. That's a good reason. So here's an example of a note payable, short-term note payable. August 23rd, company asked Graw, hold on, let's just say, to accept $100 cash and a 60-day 12% no payable $500 note to replace an existing accounts payable. In other words, somebody didn't pay his bill, so converting it from accounts payable to notes payable with interest. Oh, and you owe me $100 up front. So, debit accounts payable $600. I give them $100 cash, so credit cash $100, and notes payable $500. That's the remaining balance, right? $500. Now, some time has passed, and now I owe the rest of the loan. So I owe the $500. That's what's left. I also owe some interest, the interest being 12%. So here's the formula. The formula is principal balance times interest rate times the time. Okay, here's times the time. Principal balance times interest rate, in this case 12%, times time. Time is 60 days. Well, how do you compute 60 days? You take 60 divided by 360. 60 divided by 360. Now remember, the reason why we do 360 days instead of 365 days is because there are only 360 banking days in a year. That's why 360, not 365. So I know that part gets confusing, so I just want to make sure everyone's clear on that. So we take principal balance, 500, times 12% interest, times 60 over 360, which is 60 days, time, equals $10. So $10 interest. So I debit notes payable, 500, to reduce the notes payable. I debit interest expense to increase the interest expense. And I credit cash, 510. Make sense? Got it?
Yes.
Great, thank you. Oh, here's a good one. Nope, sorry, a little too fast. Let's say we took out a short-term loan from a bank. We do that sometimes for various reasons. So on September 30, the company borrows $2,000 from the bank. Its interest rate's a little high. 12% interest for 60 days. Ooh, that might be that. These days that might be right. Okay, so I debit cash, 2,000, because I'm getting the cash from the bank. I credit notes payable, 2,000, to increase my notes payable liability currently. November 29th, so a couple months later, 2 months later, I said I'm going to repay the loan now. Just remember, the loan's only for 60 days. Time for me to repay it. November 29th. So I debit notes payable 2,000, the amount I borrowed. I debit interest expense, $40. How did I get 40? The principal amount, 2,000, times interest percentage, 12%, times time, 60 days over 360 days. So remember the what do they call order of operations? With the brackets, right? You do what's inside the brackets first, and then you do the other stuff. So you do 60 over 360 first, times 12% times 2,000. You get $40. So debit notes payable, debit interest expense, the increased interest expense, credit cash, reduce your. What if? What if your note is extended over 2 accounting periods? We need to do an adjusting entry at the end of the first accounting for interest expense that we have incurred or accrued to that date. Because remember the matching principle, right? The matching principle tells us that we need to match our expenses when they're incurred. Yeah. So because of that accounting principle, we need to do an adjusting entry at the end of the first accounting period to put that interest expense into that accounting period. Match it. So here's an example. Let's say I took out a loan in December. Well, the year ends in December. Okay, so I need to make an adjusting entry to allocate the interest I've incurred during the month of December to get it into that year. Because let's say my company's fiscal year follows the calendar year. Because of that, I need to make sure that I apply the interest expense that I earned in that year for that year. So that's why we do an adjusting entry at the end of the first accounting period to identify what we've accrued already for that year. That's the matching principle. So I borrowed $2,000, 12% in December. In fact, I've only had 15 days. I got it December 16th. And so I need to do the accrual for that. So the way I do it is it's your principal balance, or your principal amount times the 12% interest times 15 over 360. Why 15 over 360? I only had the loan for 15 days in the year 2019. Because I took it out on December 16, yeah? So that means I only had it for 15 days in 2019. So you need to make sure that, and that's how I can apply the accrued interest for 2019. The rest of it, of course, will be in 2020. And I accrue the rest of it in February when I'm paying it. So a debit interest expense $30. And I can hear you. Well, why is it 30? Remember, I already accrued $10 of that in December. So therefore it's 30. Because remember, the total interest is $40 on this loan. So 2,000 times 12% time interest times 45 days over 360. 45 days over 360. I already recognized 15 days of that loan in December. So again, we always do adjusting entries at the end of each fiscal year based on the matching principle. And that's why we broke out the loan this way. Now that we talked about other current liabilities, I want to talk about payroll. Payroll, it's important to pay your employees. It's more important to pay them correctly. Okay, once in a while, yeah, no one's perfect, I know. Once in a while, becomes a situation. The employer the employer will make an error. Errors happen. Errors happen. So it's so important that we pay our employees correctly. A lot of times, well, all the time, when you're hired by someone, assuming that you're working for that person and working for the company, you'll fill out what they call a W-4 form. W-4. Not a W-2, W-4. W-2 is what you get at the end of the year when you do tax, when you file your tax. W-4 is when you first get hired. And when you first get hired, on the W-4, you're telling your employer how many dependents you have, how much additional you want withheld, any deductions that you want withheld. It's so important that that W-4 is correct because you might have a situation where you're either overpaying to the IRS or underpaying, both of which are bad. And I'll tell you why. So payroll liabilities. Employers need to pay you accurately based off of the salary that you have or the hourly wages that you've worked. Employers oftentimes also offer employee benefits, and of course, they have to withhold taxes from your paycheck, from your contribution, and from your employer's contribution. So we'll talk a lot about how all that works. As employees, you have to pay a lot of stuff, which is why your gross pay never looks anywhere close to your net pay. A lot of times, all the time, we have to pay federal income taxes. We have to pay state and local income taxes. You might have deductions like maybe, health savings account or retirement account or there's a lot of different stuff. Yeah? Child support or some other deduction, right? There's deductions for everything. So federal income tax, state and local income tax deductions, and then there's two other ones: Medicare and Social Security. So when you look at next time you look at your paycheck stuff, take a look at the federal amount, the state amount, the local amount, your deductions, and then you'll see two other line items: is Medicare and Social Security. And these are all the things that we, the employees, pay to all of these different agencies, right? For federal, you have the IRS. For the state, you have the DC Office of Taxation. For local, you might have a local municipality. You have, well, for any other deductions, retirement savings account, whatever, right? Healthcare, all that jazz. And then you'll also see Medicare, Social Security, separate taxes. So the way your net pay is calculated, you take your gross pay minus all these things, minus federal, minus state, minus voluntary, minus Medicare, minus Social Security, equals your net pay. So net pay is the sum of the gross minus all of the taxes and deductions. Oh, and I should say, oftentimes the deductions, that's pre-tax. That's pre-tax, before tax. On the employee, on the employee side, yeah, the employee side, I'd mentioned that you have to pay Social Security taxes and Medicare taxes. And I'm sure these numbers went up. So 2018, that might be still the same actually. It's quite close. I'm sure they changed to some degree. The IRS has always changed. Federal, the federal, uh, the FICA taxes, Social Security and Medicare, Federal Insurance Contributions Act. We as employees pay 6.2% of the first $120,400 earned in a year to Social Security. Social Security is that thing that hopefully you'll get when you retire. Some of us may not see that amount. Why? Because Social Security is not being managed well by your government. The IRS is doing a terrible job of managing Social Security. Hopefully you'll see it. It's like, think of it like a savings thing. I don't know. How do you want to describe it? You pay into this, and hopefully you'll get it back. You should get it back, hopefully. But the government is doing a very poor job of managing. So hopefully we'll get it. The other thing that you're required to pay into is Medicare, which is another wonderful senior benefit. So when you reach a certain age, man, they keep raising. So before it was 62 and a half, then it was 65, and now I think it's like 67 and it depends on retirement year and all that. Medicare is basically like it's almost like medical insurance. When you get older, when you're retired, 1.45% of all wages goes to Medicare. That's still pretty good, but that's still a good service. I mean, it's still not as good as it could be. Can't rely on the government to do anything correctly, in my opinion. No offense to any government employees here, but they're not very good money managers. Let's put it that way. So we also have to pay. We also have to pay federal income tax and state income tax. Now that's all the stuff you, the employee, pays. The employer has to pay similar taxes. They also have to pay federal and state, but they have to pay when it comes to the Social Security thing and the Medicare thing. They also have to pay into those things, but on top of that, they also have to pay unemployment insurance, and so I'll talk about that. Employees, you the employer, you might also have voluntary deductions like union dues, savings, health savings accounts, pension plans, insurance premiums, charities, whatever. Like so many different possible deductions. Child support, the list goes on and on. In addition to those, employers sometimes will also withhold voluntary amounts from the employees and send those to those respective agencies. Well, they should, anyway, part of their responsibility. But another thing I wanted to talk about that I will here shortly is on the employer side of things, because the employer has to pay into unemployment insurance, which is in the event that you, the employee, become unemployed. When you go to apply to this unemployment thing that each jurisdiction has, that was money that your previous employers paid into in the event that you became unemployed for whatever reason. That's how that money got there. And that's how much they know how much to pay you during your unemployment. Just something to think about, right? Because sometimes people are like, oh, I don't know how this money got here. It's like, well, your employer's paid. Okay, I'm going to go through a couple journal entries. At the end of each month, and of each 2 weeks, really you should be doing this at the end of each 2 weeks. Some employers do it at the end of each month, depends on the size of the employer. At the end of the 2 weeks, each 2 weeks, there will be a journal entry that look like this. We debit salaries expense, and then we credit all the payables. We credit Social Security tax payable, Medicare tax payable. We credit federal income tax payable, medical insurance payable, employee union dues payable, and of course salaries payable. So here's how I want you to think of this. On the debit side, we have the gross amount, GROSS, the gross amount. On the credit side, we have all the taxes and the deductions. And then at the bottom where it says salaries payable, that's your net pay. Make sense? Good so far. Yeah, okay, great. And of course, this next journal entry is to record the payment of the salaries payable. To pay our employees, of course. Now here comes the fun part. The contributions from the employer. The employer also has to pay all of these federal and state unemployment taxes, the Medicare taxes, and the federal insure. I can never get that one right. The federal something something insurance something act. So far. Okay, sorry. So remember, you, the employee, you had to pay the taxes too. You had to pay federal and state taxes, you had to pay Medicare taxes, you had to pay Social Security taxes. Your employer has to do the same thing. Except the difference here is that they don't pay the federal and state taxes for the employees, but they do pay the federal and state unemployment taxes for the employee. Now, the Social Security amount and the Medicare amounts are the same exact that the employee pays into it. It's kind of like a match. That's part of the law. But the difference is the employer has to pay the federal and state unemployment taxes as well. So here's how it works. The federal unemployment tax. Employers have to pay 6% on the first 7,000 of wages paid to each employee. Credit up to 5.4% given on the state unemployment tax. Therefore, it's a net of 0.6. I think that's changed a little bit since this was probably written. It's around there, because I don't know if the federal government still does the credit part. I don't think they do, but I could be wrong. On the state side of things, like DC government side of things, or the if you live in like Virginia or Maryland or whatever, the state, the employer has to pay to your respective state the unemployment tax, which is 5.4% on the first 7,000 of wages for each employee. In some jurisdictions, it's actually a little lower than that, but most it's probably the same, if not higher. Just goes to show you that your employer, you may not think that they're paying the same as you. The reality is they're usually paying more than you are in terms of taxation. So just something to think about. You give your employer a little credit. Okay, here is a journal entry for taxes on the employer side. We debit payroll tax expense, and we credit all the different payroll taxes. Social Security tax, Medicare tax, state unemployment tax, federal unemployment tax. So yeah, it's very, very similar to what's being withheld from employees. That's why it's such an interesting discussion, about all the different taxes. So yeah, payroll. Isn't it fun? Oh, it's not too fun. In most larger accounting offices, when I was the financial controller at the hotel, we had an individual person doing all of the payroll, separate from accounts payable, separate from accounts receivable. We had a separate person doing payroll, just dedicated to payroll. That's all they did. That's all she did. And that was her job, was to do all of these payroll entries. It's not easy when you have hundreds and hundreds and hundreds of employees to track. You're tracking their time, the timekeeping. Uh, Oftentimes you have to interact with employee hiring. You have to prepare payroll, keep their time, and pay them. Right? There's a lot of stuff that payroll people have to do, and those were her primary responsibilities. And she also had to do all those journal entries, and that must have been terrible. I'm thinking about all the work that goes into it. Earlier, I mentioned this thing called multi-period known liabilities. This is when we were talking about liabilities before we jumped into payroll liabilities. I mentioned this thing called multi-period known liabilities. This could include things like unearned revenues and notes payable. They're over multiple accounting periods. That's why we call multi-period known liabilities. As I mentioned time and time before, unearned revenues is when we've received payment for something we have not either given to our customer or provided the service yet. Basically, they paid us in advance, right? So that's unearned revenue. It becomes earned when we deliver the good or the service. And that can be done over multiple periods of time. I gave the example of the lawn care business, right? So in the lawn care business, they might pay you for the season. The season is multiple accounting periods, it's multiple months. Notes payable. Notes payable is a loan. It's a loan. Um, Oftentimes, are greater than 1 year, and and this is what I was telling you earlier about the current portion of long-term debt. The current portion of a 5-year loan for the car that you bought is the first 12 months. That's always going to be the current portion. Even after you pay that first month off, it's the next 12 months, and then the next 12 months, and then the next 12 months. It moves along with the payments. The current portion is that first consecutive 12 months. It's a long-term debt though, because it's greater than 1 year. So current portion of long-term debt. Everyone's good so far, right? Yeah, doing all right. Okay, great. Thank you. Okay, sometimes uh, we may not um, know that a liability will happen. What do I mean? Let's say you bought a new TV or a new computer. Let's say, oh yeah, you bought a new computer. Good for you. So happy for you. Things happen. through electronics, don't they? Oh, my phone, I fell down the stairs. Oh, my computer got ran over by my car. Uh, who knows, right? Oh, I left my computer on the bus. Oh, I spilled water all over my computer. Oh, I spilled coffee all over my computer. Yeah, these happen. These things happen. But that's why you may have also purchased this thing called a warranty. A warranty can be helpful, yes? A warranty protects your investment up to a certain amount. It protects your thing that you purchased. Warranty. Sometimes it even protects it against yourself. If you do something to it. Or if something naturally breaks. Oh, the fan on my laptop broke. Whatever. Things happen. It might be covered under warranty. In business, the warranty costs us money. If I'm selling you a warranty and you use that warranty, it's costing me money, right? Yeah, of course. So we can estimate that somebody will use the warranty. And so we call that an estimated liability. Somebody might use that warranty. A pension, that's another estimated liability. I might retire. I don't know. Healthcare, vacation pay, somebody might use their healthcare. Somebody might use their vacation time. Somebody might claim a warranty. These are all things that we can estimate that might happen to the business. Here's an example. Let's say that we have employees. They are paying into our employee benefit program. In our employee benefit program, we offer medical retirement things because we're a nice company. That's what we do. And so our employee, as an employer, we pay into those things along with you. So I need to record the fact that I'm paying into these programs for my employees. So let's assume that we agree to pay for medical insurance up to $8,000, and we're going to contribute 10% of our employees' salary to retirement. Oh, that's nice of us. So we debit employee benefit expense, and we credit employee medical insurance payable and employee retirement program payable. These payables are accounts that we estimate. We estimate that we'll have to pay out. We might not ever pay it out. We might pay it out. We might not pay as much. We might pay more. We're estimating that we're going to pay out $8,000 in medical insurance and $12,000, $120,000, or I was right, $12,000 in retirement. We're estimating. Same thing with vacation. Employees uh, accrue vacation over time based off of the time that they've been with the company, based on how long they've been there, how long, or maybe it's based off of they just give it to you up front, whatever. But you might take a vacation, so I need to estimate that you might take a vacation. So I'll debit vacation benefit expense and credit vacation benefits payable to record vacation benefits that have been accrued over time. Now, when you take the vacation, and I recommend that you do, I will debit vacation benefits payable and credit cash. That's why, like, when you do take vacation and you enter your time for your employer to see it, what happens is that on your paycheck, on your payroll stub, you'll see it. The normal hours will be deducted by the amount of vacation hours that you took, and then there'll be a new line item that'll say vacation benefits, and it'll have the amount of hours of vacation time at their respective amount. So that's what this is. That's on the employer side. Same with bonuses. Some employer some employers are nice. I'll give you a bonus. Yeah, once in a while it happens. Hey, you're a great employee. Here's a bonus. So that's nice. Okay, so let's assume that we'll pay $10,000 in bonuses at some point in the future, be shared by all employees. Well, it's not as nice, but that's still nice. So I debit employee bonus expense and I credit bonuses payable. Let's go back to my warranty thing. Something happened to your laptop. Now I got to replace it or fix it. Your laptop stopped working during a certain amount of time, so it's within warranty. No problem. We'll get it fixed for you. The seller reports the expected warranty expense in the accounting period in which the revenue from the sale was reported. Remember that matching principle thing. That's why we do that. The seller reports the warranty as a liability. Because remember, I have to estimate that someone's going to want to collect on this warranty. So here's our example. December 1, I sell a car for $16,000. It has a 1-year warranty. It's a used car. Okay? Past experience tells us that an average of 4% of our sales will have a warranty claim. That's where we get the estimate. Yeah? I'm estimating that 4% of my sales will have a warranty claim. So on December 1, I'm estimating debit warranty expense 640, credit estimated warranty liability. Because remember, I'm estimating that 4% of 16,000 is going to claim on a liability. And then, surprise, surprise, January 9th, I got a customer that comes in for warranty repairs, $200. So I debit estimated warranty liability and I credit auto parts inventory, my inventory account. Because I'm using that warranty liability money and my inventory to record the cost. Contingencies. These are rare, they happen. Sometimes we have to plan for things. If there's a strong probability that something will happen, like a warranty claim, for example, strong probability, we can estimate the amount and record it as a liability. If we cannot estimate it, we'll put it in our notes. If there's a slight possible chance that a customer will experience a loss, we will disclose that in our notes to the financial statement. If there is a very remote chance that something will happen, like a very slight possibility, there's no need to disclose that in the notes. Call that contingency. Contingencies. If something is reasonably possible to happen, we disclose it and we estimate. We identify possible legal claims, any debt guarantees, and other contingencies. These are all notations to the financial statements in the event that someone claims on a warranty for whatever reason. And of course, there's other things that we cannot predict, and so some things are disclosed based off of their predictability or the possible chances of something happening. And these are all things disclosed in our financial statement notes. Here's that ratio I told you about that you guys love. This one's called times interest earned. It's good to know because it tells us about risk to the possibility of something happening. Times interest. It's the income before interest and income taxes that's found on your income statement toward the bottom, divided by interest expense, also found on the income statement under expenses. And here's a nice application of that ratio. Payroll. I told you about the W-4. That's when you were first hired. That's a part of procedures. The IRS every year publishes this thing called the withholdings table. Usually that's the number of dependents that you identify. Those are all part of payroll procedures. Every accounting period, I need to report things. I report W-2s. At the end of each accounting year, or end of each year. I report IRS Forms 940 and 941. For payroll records, I track paychecks, earnings reports, and registers. Those are all payroll records. You need to keep that for 10 years. Those of you who are employing people. Corporate income tax. Corporations need to pay taxes on their income just like you do. So we do accruals for that, of course. We debit income taxes expense and credit income taxes payable. And of course, we pay that on April 15th. Income taxes payable, debit, credit cash. You're supposed to do that every quarter. So for those of you who own businesses or getting ready to, please make sure that you file and pay quarterly estimated payments to the IRS. The reason why it's important to do that quarterly is because the IRS is notorious for finding ways to collect more money from you if you don't do it that way. Understand? Pay the IRS on time. Don't screw around with them. I'm telling you, the IRS is worse than the KGB. They have unlimited collectability. So don't screw around with the IRS. That is my advice for today. And with that, the end of our discussion on payroll and current liabilities. Any questions so far? It's true. It's so true. Okay. I'm going to stop this recording and then let's take a short break. Hold on.